So in this video, we're going to be talking about C corporations separately and what their benefits are and things you should know about C corporations. Really, the first thing that you should know about a C corporation is that it's a shield against personal liability. That's really what corporations are all about. Corporations are recognized as legal entities. They can sue, they can be sued, they can enter into contracts, they can buy stuff, they can sell stuff, they can hurt people, they can help people, make corporate donations, they can contribute to political campaigns, do all kinds of things. But the most important thing for you to remember is that you set up a corporation, and a C corporation is one of these, so that your personal assets are not at risk for any of the activities of the business, unless you step outside of that by basically allowing someone to what's called pierce the corporate veil, which is a topic that's well beyond the subject of this little quick video. The most important thing is to remember that there's a shield against personal liability, and therefore it's a really good idea. It's also a more formal structure than a lot of the other entity choices that you could come into. For example, I like to say that good fences make good neighbors, but what I mean by that is most companies, most people know what corporations are, know how to deal with them, understand that they're governed by certain rules, and in fact, as you choose what state you want to incorporate in, which is a big question sometimes, certain states have better sets of corporate rules that apply to them. Now, which state should you choose? Again, as I said in other videos, you really need to consult your lawyer about that. Some of the prime ones that are chosen are Delaware, Nevada, and increasingly Wyoming, believe it or not. But my advice, particularly with smaller businesses, is to choose the state that you live in. Another important aspect is that it's easy to transfer your interests when you're dealing with a corporation. Think about it. If you, Coca-Cola is an example. If you own shares of Coca-Cola, it really doesn't take much to transfer the shares of Coca-Cola to somebody else. In fact, Coca-Cola really, for the most part, doesn't even need to be involved with that in any way, shape, or form. So that is a really valuable asset, and it allows you increasing flexibility when you think about your exit strategy, which is something that you really, really need to be thinking about as you decide what kind of company you want to have, what entity structure you want to have, because different entities have different ways of getting out of them, and some are easier than others. The C corporation is far and away the easiest to get out of, and as a part of that, it will survive you. So in other words, when you pass away, or you have a breakdown, or you're disabled, or whatever, if you have it in the form of a C corporation, you can really, the business can go on without you. Now, don't get me wrong, that doesn't get to the day-to-day business where will they be able to still make the donuts without you? That's another question. But if you are in a partnership, or for example, or in a sole proprietorship where the business is essentially you, if you die, the business dies. That's not true with a C Corp. It continues after you, survives after you. As part of that, it also, as I mentioned before, it lowers the blood pressure of people who are dealing with a company if you've got a C corporation. And therefore, it is easier to get outside funding for projects. Whether you do that funding by getting people to give money to the corporation in the form of a loan, whether you sell them shares, however you choose to have them invest into the company, it is more easy to get people to participate because corporations are more easily understood. Now, if you're dealing with people who are from other countries, they will understand U.S. corporate law generally better than they'll understand other entity forms. They just will. Now, don't get me wrong. German corporations in particular are very different than U.S. corporations. They have different rules, different obligations. But as a general principle, it is easier for someone outside of the United States who's looking to invest in this country for them to invest in a C Corp. And there are other entities, if you will, that they can't invest in. For example, an S-corp, which we'll talk about in another video. However, with all of that said, there is an important downside. And the reason that most people choose not to invest or not to create C Corps when they create business. And that is this double taxation problem. The double taxation problem is very simple. Money comes into the company, and then remember, it is a separate legal entity. And when the money comes into the company, it is taxed. Now, of course, there are always deductions and expenses and all the other stuff, but whatever the profits are, they are taxed. And then when you, the owner of the company, take the money out of the company, you are taxed a second time. There is no pass-through with a C corporation. That is not true with any of the other entities that we're discussing. So generally, when you're dealing with smaller companies, the C corporation form is generally disfavored because, frankly, it's not worth paying taxes twice. You think about it, even if you're paying a minimal amount of corporate tax, if you add that to the tax that you're already going to pay on the personal side, it can be the difference between staying afloat and going under. So very quickly, those were the 5 big things that I think you should be thinking about when you are talking about C corporations. If you've liked this video, please like it down below. Send me a comment. I'd love to know what you think I may have missed, and by all means subscribe to this channel where I'll be coming up with more videos about the different entity types going forward, and I hope to hear from you soon.